I'd like to talk for a minute about the two basic types of life insurance, because you know the insurance companies have their labels for different kinds of policies. We as insurance advisors talk about different kinds of term insurance and universal life insurance and permanent insurance. When you boil it all down, and part of the process I think of doing a good job for our clients is to keep things simple and understandable. When you boil it all down, there are only two types of life insurance. One is if I die, and the second is when I die. And if I die life insurance is any policy that's going to run for a period of time. The attorney I mentioned to you a little while ago that wants insurance to continue until he retires or gets very close to retirement. He wants protection if he dies in the next several years while he's working. That's a finite period of time. We don't know exactly how long that'll be, but we can give a pretty good estimate. Another real obvious example of if I die insurance is a family having typically term insurance protection while children are being raised, so that if either spouse dies and there's a loss of income, that there are funds to pay off a mortgage, funds to set aside for children's education, maybe funds to help replace the loss of income from the deceased spouse. And as time goes along and the children are grown and through school and retirement assets are accumulated, those insurance needs will decline and may at some point end. And if that's the case, you know, there are various periods of time, but those are all if I die insurance discussions. The other alternative, which is what we were talking about in the two case studies, is when I die life insurance, where the client wants the life insurance to be there at death, whether death occurs at 50, 80, or 102. And usually it's either for, you know, inheritance purposes or it's for estate planning. And neither is right or wrong or good or bad. It's a matter of talking with the clients about their objectives and finding out what is right for each person's situation, and then making sure the insurance matches what the client's objectives are. And I'll give you a couple of examples because one of the biggest problems is there are a lot of policies out there that were purchased as when I die insurance that with the decline in interest rates and kind of a less than spectacular stock market environment over the last several years, those policies, instead of being when I die, are now if I die. And if the person lives too long, they're going to find that the policy won't be there to pay the death benefit. And that can be fixed if you're working ahead. It's probably prohibitively expensive to fix at the last minute. And I talked with a lady not too long ago who's involved in a family business here in Madison, and they had a policy on her father. It was several $1 million. And it was purchased 20 years ago when interest rates were much higher. It was not purchased through our office. The policy was not serviced, which is not uncommon. And they learned when their dad was 85 years of age that the policy was about to lapse. And the cost of continuing the insurance is essentially the cost of term insurance on several $1 million from 85 to 86, and 86 to 87, and 87 to 88, until death occurs, and they decided it was prohibitively expensive. And their father died at about age 90, and the several $1 million of insurance that had been put in place and premiums paid as a part of the overall family, you know, financial and estate planning wasn't there. We've got a situation right now where a financial advisor sent me an email last week, has a client who's about 60 years of age, and he said she has $1 million policy that she wants to keep for the rest of her life, and it doesn't look like it's working just right. Do we need to get a second opinion? And obviously we didn't write the insurance. They were wondering if we could give an opinion. Well, the policy is only guaranteed to age 75. which is a long way short of her life expectancy. It is a policy design that is inherently difficult to predict how much funding it needs to keep it going to age 100 and beyond. And she's been paying a premium that's roughly equivalent to about a 15-year term premium, which means that the policy is going to quit at somewhere between 70 and 80. So for what the objectives are that were stated in the email to me, this policy is way out of whack. And whether it means there should be a different policy or whether the current policy should be adjusted, I don't know at this point. We don't know anything about the lady's health, and we need to verify the intentions and see if they in fact do want to talk further with us. But I do know categorically that that policy, as it's currently structured, will not meet the objectives that the financial advisor stated in the email. And this lady at age 60 can fix all of that. So if you can identify these discrepancies, either, and then the client would either change their expectations, pay more premiums, or get a different policy. But between those three choices, there are things that can be done. When you find out that the policy is about to lapse and underfunded in a person's 80s or 90s, it is not fixable. And that's why you want to help people proactively.